Good morning. We're at the Schuylkill River here I'm here to watch my boys do a regatta. And I figured, why not take a little walk, talk about mortgage-backed securities, MBS. So at its core, we're going to talk about securitization. You actually can't talk MBS, mortgage-backed securities, without understanding securitization and debt. I'll touch on debt in a second. If you've never heard of securitization, let's take a moment. Think about a payment outside of mortgage payments, which we're going to talk about for most of this walk. Think about a payment that everyone you know makes monthly. Two things I can think of, one big, one small. The big one, credit card payments. And most people do the worst thing possible and pay only the minimum required from their bank on their credit card monthly. So they keep paying like $50 or $99 a month. Now, hold that thought for a moment. Here's the smaller version or smaller example of payments that everyone makes, or at least everyone wealthy makes. 99 cents every month for Apple's iPhone iCloud storage. Now, I personally have grown numb to the 99 cents per month charge. And my wife, who takes enough pictures to fill a library every day, pays about $5 a month, like clockwork. Now, imagine that you wanted to sell cash flow. You have money, but you want to buy more money, regular monthly flow of money. Now, I could buy 1 million people's credit cards, their credit card debt, that those people are still like paying for every month, minimum due, minimum due, minimum due. And I could securitize that cash flow, meaning I could sell you the cash flow I get from those 1 million people paying off their credit cards. They keep paying monthly. They think their money is going to their bank, but it's going to me now. And I've sold it to you. So their monthly goes to the bank, then to me, then to you. That's me securitizing credit card debt, credit card backed securities. One more example, that Apple iCloud payment that I make, which I'm not paying interest on, but still illustrative potential securitization. I'm confident that like 100 million people, 100 million other iPhone users also make it. In theory, I could buy that regular stream of income from Apple, package it as a cash flow producing product, and sell it to you. So all those iPhone users who have no idea, how to download their pictures to their PC for free, all those iPhone users who will keep making 99-cent payments for the rest of their lives, they would keep paying Apple. Apple would forward that cash to me, and I would securitize. I would sell that cash flow as, let's call it, iCloud-based securities. You just need to find something that large numbers of people are compelled to pay for, preferably that they're paying interest on. Buy that debt from whoever is receiving the monthly checks, package it as a cash-producing product, and get pension funds to buy it. Easy peasy. Apply that iCloud principle to your parents' mortgage, and you get mortgage-backed securities. That's the high level. On this walk, I'll get into the details about the more commonly encountered types of mortgage-backed securities, what are called pass-through securities. Do a tiny bit on CMOs, Collateralized Mortgage Obligations. Don't worry, I'll explain that, as well as a lot of other concepts used to assess the attractiveness of mortgage-backed securities. And I'll get into some details that should help you understand the mortgage securities market and how it works. I said I'll also touch on debt. If you are not familiar with debt instruments, DEBT, debt instruments. They're assets that require a fixed payment to the holder, usually with interest. Examples would be like bonds, government bonds, corporate bonds, and what we're going to talk about, mortgages. Debt instruments are the boring cousin of equity instruments, the whole flashy stock market. Who buys debt instruments? Usually it's institutional players like corporations, governments that have a much lower risk tolerance than those crazy hedge fund guys. Institutions that they can't lose the money that they're safeguarding. Like, as I mentioned, pensions, right? Imagine that you're ready to retire and you get a letter from your pension saying, sorry, we lost it all on GameStop. Not cool, right? So lower risk tolerance. And it's not just institutions, by the way, that hold debt instruments. If you have a well-balanced portfolio, debt instruments help diversify that portfolio. That, by the way, is a train. I don't know if you can see. So if you have a balanced portfolio, debt instruments help you diversify, and they reduce your risk, earning you reliable monthly income, fixed income. That's why they call it that, fixed income. A lot of older folks love fixed income because it's a regular paycheck. So mortgage-backed securities are debt instruments built by pooling large numbers of similar individual mortgage contracts, securitized into products where you're selling their cash flow, their monthly cash flow. Securitization, process by which certain types of debt, 99-cent cloud storage or $99 credit card payments or $9,000 monthly mortgage payments, are pooled as assets so that they can be repackaged, securitized into interest-bearing securities. The payments from the assets in the pool are passed through to the security. Okay, we'll let the train pass. You're right. It's right above us. Okay, so we'll soon get into the details of the most common type of mortgage-backed securities, which I already said, back there. They're known as pass-through securities. That'll be a good starting point for learning about mortgages themselves. Like if you've never taken a mortgage, before they're securitized, we'll learn about what a mortgage is and what the process of securitization actually involves. I'll also, if I have enough of a walk, talk about what causes mortgages to have risks that differ from all those other types of securities. Risks like the uncertainty related to what's called prepayment. It's prepayment risk, which I'll also define shortly. And I'll touch on other big words that have easy definitions like embedded optionality or uncertain average life, which, if you think about it, would be a great title for my autobiography, Uncertain Average Life. Okay, if I have time on the walk, which I think I will because I think this is a long walk, I'll get into the numbers involved, concepts like the rate of return, price, prepayment rates. But if I don't, you can just Google that, and I'll probably need a second walk to get into all the different types of mortgage-backed securities, the ones that are more complicated than pass-through securities. Those are the CMOs I mentioned about 1,000 years back, Collateralized Mortgage Obligations, CMO, and others. Okay, so let's talk risk. What is a mortgage-backed security? It is an investment where the cash flows to investors come from mortgage loans, not one mortgage loan, but like a group of mortgage loans held together in some kind of legal entity. That entity is also called a mortgage pool. I'll probably call it a pool the entire walk. And these structures can get complicated. And I'll try to touch on some of that on the walk. But that's what distinguishes mortgage-backed securities from other sorts of investments. The cash flows to investors are being paid by borrowers who are just, paying their mortgage loans, paying them off month by month. And that money, after passing through some number of hands, ends up in the hands of investors. You think it's going to your bank, but you'll soon learn it's not. Now, just that cash flow would be compelling enough as a product, but it's better than that with mortgage-backed securities because many also have additional guarantees or what are called credit enhancements, which means that, some poor person whose mortgage is in the pool, when he or she or they can't make their mortgage payment, when they default or are delinquent, there's some other source of cash, like a government or government agency guarantee, some sort of like private insurance or cash reserve built inside the structure itself that makes up for the potential loss. That's the guarantee. So you're not getting potential cash flow, it's guaranteed. Not all mortgage-backed securities are that solid, as 2008 definitely showed us all, but we'll get to that. Because as with all my walks, we'll talk risk, not, generally like the risks in other debt instruments, fixed income securities, like, what's a good example of a general risk? Inflation and its negative impact on the investor's purchasing power. That's a standard risk. Mortgage-backed securities have their own flavor of risks. It's a little bit more spicy. Two broad categories of risk for them. One relates to the uncertainty around how slowly or how quickly the borrowers, the mortgager, is going to pay off the loan. And the other big risk, especially for investors who care about credit quality of what they're buying, is the complexity around what's called average life. I mentioned it before. Story of my life, remember? The loans, mortgages, and bonds, the average life is the average period of time before the debt is repaid through amortization. Investors use the calculation, the average life calculation, to measure the risk associated with amortizing bonds, loans, and, what we're talking about, mortgage-backed securities. And while we're riffing on risk, there's also credit risk, very important, which credit risk is the possibility of loss tied to a borrower's defaulting on a loan or not meeting its, contractual obligations. That credit risk is mitigated by guarantees that make certain mortgage-backed securities golden. Full confession, memorize some credit score ranges exactly for this, and we'll get into it in about a mile up river. Just know, before we get there, that there are certain types of mortgage-backed securities that mitigate credit risk because they're backed by a government agency, an agency guarantee, government guarantee. Zero chance that I won't mention those agencies. Ginnie Mae, Fannie Mae, Freddie Mac there. I mentioned them, but I'll get into them a little bit more, and into a little bit more detail. They're not the only providers of mortgage-backed securities, which should tell you that there are plenty of mortgage-backed securities that are not protected by any sort of guarantee, where credit risk leads to, credit crisis. Think 2008 financial crisis, which I'll also mention on the walk. Okay, so you can't talk about MBS without understanding credit risk. There's two kinds. One revolves around the question of the quality of the loans in the pool, something called the underwriting standards, which is industry jargon for the rules that determine whether a borrower is worthy of credit or creditworthy. If they rise up to the standards of a good mortgage taker, mortgager. How serious are lenders in figuring that out? If you're taking out a loan, deadly serious, because the credit quality of the borrower will determine, in large part, whether the lender can get the mortgage off their books by selling it into a pool, that legal entity we talked about as a mortgage-backed security. It's in the name of credit risk that everyone in the business asks questions like, what was there a large or small down payment? What sort of income or assets did the borrower have to fall back? Why was the property purchased? Is the property going to be the borrower's primary residence, or was it purchased as an investment property? And as we'll see later on the walk, all of those answers go into assessing the credit worthiness of the larger pool of assets that are bundled into mortgage-backed securities. And all of those answers go into assessing the amount of credit risk investors in mortgage-backed securities are exposed to. Both sides. The other question worth asking, this is so cool. That's people doing crew. Anyway, the other question worth asking, are there any guarantees or credit enhancements that can offset credit risk? Okay, so let's talk origin story. How are mortgage-backed securities created or syndicated? The process, called origination or asset securitization, involves creating an underlying legal structure. We already touched on that. It's also called a pool. That's what we said. It involves filling that legal entity with a ton of similar mortgages and then selling the cash flow from that pool to investors. That's asset securitization in 3 steps. That's the most basic sort of structuring that goes on. The pooling together of a bunch of mortgage loans, usually very homogeneous loans, so they are all very similar to one another. Asset securitization uses the money that those people with mortgages in the pool to, serve as the cash flow to the investors. Why is it important that you do it at scale, not just 1 or 2 mortgages? Why is it important that you buy a pool? Well, there are 2 reasons. Securitized loans, pools, are more attractive than individual loans. One is the benefit of diversification, because by investing in the pool, in effect, you offset all the hiccups that happen in onesies and twosies. They become tolerable blips in large pools. So your investment is diversified across many borrowers as opposed to being dependent on one borrower, if you own only 1 mortgage or 2 mortgages. The other potential advantage to a pool is that, in general, securitized assets are going to be a lot more liquid. Easy to sell. Part of the securitization process is securitizing these instruments in a form that makes the ownership interest relatively easily transferred. It's still not super easy like stocks, but it's relatively easily transferred to, some other party, as opposed to the difficulty of just trying to sell 1 or 2 mortgage loans individually. Think of all the lawyers you'd need, if you're doing onesie twosies. Individual mortgage loans can be traded between parties, but each loan is a unique document like this thick, and moving it around will require going over the details in, that. Because of the standardization of these structures, these pools, they all have common features like a common legal framework that makes the transfer of ownership for a piece of that pool from one holder to another relatively painless. Fewer lawyers. It's never no lawyers. Fewer is better. And with a pool, your investment is diversified and more liquid, and that's by design. These markets were created by governments to grow home ownership by making mortgage markets work more efficiently. Pools are also, they also help recycle capital back into the lending system. In theory, allowing borrowers to land the loans they need to buy their dream homes. And that, in theory, benefits those governments and their societies because property ownership leads to responsible citizenship, in theory. I know plenty of homeowners who are terrible. I call them my friends. Now, that is one part of the structuring, a fancy word for designing. So, one part of designing structured securities, the other part is designing or structuring the payout to investors. The first kind of securities we're going to talk about, the pass-through securities. There is no structuring of the payouts. Gets a proportional share of the cash flows. The downside is investors have a relatively, harder time managing the risk exposure of holding that investment. That's why the product matured to have structured payouts. All right. Historically, pre-1970, pre-securitization, loans just sat there, earning interest as boring assets on the balance sheets of the lender. We just watch paint dry as interest earning assets for the entire life of the loan. Then some clever person on Wall Street saw a way to make it sexy. Well, sexy by Wall Street standards. This was the 1970s, and lenders started selling those loans to parties that would securitize them, pool the loans, and allow investors to buy an interest in the pool of loans. I want to buy a house, so I'd go to a lender, usually a bank, and they'd sell me a 30-year loan, but only after I'd put down 10%, 10% of my home's cost. My money. Why? They wanted me to have skin in the game. Back then, a home cost like $100,000. I put down $10K, which was a lot of money back then, and I'd pay the other $90,000 plus interest over the next 30 years. In a few years, in the first few years of the loan, I'd do anything to keep paying my mortgage because I didn't want to lose that 10K I'd put down. And that fear of loss would actually grow with each passing year, because after 10 years of paying my loan, I would have built equity in the loan, in the home, excuse me. I don't own $10,000 worth of my home after 10 years. I own like, $30K. So the incentive to keep paying the mortgage would grow with time, making a mortgage loan one of the safest uses of a bank's money. Then securitization came along, and the banks, who had all, they had all these safe assets, individual loans sitting in their balance sheets, realized that they could make more money on them by selling them to the syndicators of the pools, the creators of these giant mortgage pools. The bank or lender would get an interest in that loan pool in return for handling their safe loans over to the creators of the pool, the people on Wall Street. Now, I'm still that guy in the 1970s with the 90K mortgage. I'm paying it off month by month, and each month I'm paying mostly interest, in the first 10 years of the loan. And if I'm lucky, a little piece of the principal. I pay more and more of the principal towards the back end of the 30 years. That's just how amortization works. As the borrower, I just think I'm paying my bank each month. But once my mortgage becomes a part of a pool, I, along with everyone else who owns a mortgage in that pool, are actually paying the investors in that securitized pool. The interest I'm paying, the interest everyone in that pool is paying, is cash flow to the investors of that pool. That loan pool is actually a legal entity, a trust or corporation, and all monthly income, the interest we're paying and the principal we're paying, is passed to investors in that legal entity. Those investors are getting our payments based on their percent participation in that pool, meaning like if I own 50% of the pool, I get 50% of all the money that the pool is generating. Well, not exactly 50%, because The people who put the pool together charge various fees and expenses, but enough of the money of all those homeowners' monthly checks comes through to make it an attractive investment for, certain investors, like large mutual funds or any large institution charged with protecting and investing people's money. Hell, the US government buys mortgage-backed securities. Up until the syndicators, the creators of the pools, started messing around with subprime loans, garbage loans to people who weren't going to lose any of their own money if they stopped paying their mortgages. Up until then, mortgage-backed securities were solid, safe, boring vehicles, investments. We'll get into the why later on. How does the distribution to the investors work? That depends on the securitization. For instance, I kept using the term pass-through, which basically means that the money given to the loan by all the mortgage owners in that pool is passed through, hence the term, to the investors. Investors get their percent share, their pro rata, their pre-agreed fair share, pro rata, of every dollar passing through. But that's pass-through. There's also another structure called a pay-through, which, it's where all the money the pool collects will pay out, minus those fees and expenses, to investors based on tranches or groups that are organized by their risk, reward, and cost. Let me explain. But first, let me use those three big words again. Collateralized Mortgage Obligation, CMO. That's what we're talking about. If I'm a syndicator and I've made this pool of 1,000 mortgages, I can start to slice and dice them to produce bundles within those 1,000 mortgages that are safer and therefore more expensive, or I can make them riskier and therefore less expensive. I can create these bundles, these groups, these tranches. That's what the official term of art is, tranche, that I can create them to appeal to different kinds of investors, different kinds of buyers. I can even name those bundles, those tranches, something that signals their risk, reward, and cost, like a silver, gold, and platinum tranche, or a double A, triple A, or zillion A tranche. I'm going to walk behind these beautiful, beautiful trees. As a syndicator, it's in my best interest to offer, different risk, reward, cost bundles at different prices because there are investors with different needs. But that's what a pay-through structure, as opposed to a pass-through structure, is. A pay-through says, hey, if you bought the platinum bundle, the AAA bundle tranche, you get more, you get better than the gold AA. And that gold AA gets more or better than the silver single A. And the word better for all investors is always tied to risk management. For example, if something awful happens with the pool, an investor defines better as being paid out before all the other investors who are in line. You pay more for platinum and AAA, so you can sleep easier at night. So the best bundle or tranche of a collateralized mortgage obligation, CMO, would be like, not only do you get the interest being paid on these loans, but you also get the principal, and lower tiers in CMOs don't get principal, right? And not only do you get more of the principal and the interest, but if something goes boom, you get paid out first. So you see this kind of differentiation across all tranches or CMO sorts of investments, while the vast majority of investors in the various tranches will be earning some interest from the pool. There's a first class cabin on that plane, which you pay more for. And in there, you get champagne, principal. You get caviar, risk reduction, like, if the plane goes down, you're the first out the exit. Not all investors want first class tickets or can afford them. Some are fine with just interest, not, monthly chunks of the principal. Some are fine with being in the row furthest back on the plane because they know how to swim. The CMO product returns to investors the value that they're willing to pay for, the kind of priority and access they're willing to pay for. And it's done by having different tranches of risk-reward trade-offs. So at a high level, that's what a tranche, what a pay-through looks like. Let's go deep, though. The vast majority of mortgage-backed securities are what they refer to as RMBS. The R before MBS stands for residential. So the vast majority of mortgage securitizations are based on residential properties, people's homes, right? RMBS. But that's not all. You put a C in front of MBS. And that C stands for commercial, people's businesses. This is probably a good point to introduce two terms of art, industry-specific jargon: recourse and non-recourse loans. This is a way of describing who you can sue and for what if you're a lender. You can think about it as lender rights. What can they do if the borrower defaults on, a loan that they've put out? There are nation by nation, jurisdiction by jurisdiction differences here. The US, for instance, is called a non-recourse country. If I'm in the US and I default on my loan, because it's a non-recourse loan, my lender can't go after my other personal assets, right? They have no recourse. And anyway, they have no recourse other than, to recover their money by selling the property I took the loan on. As the borrower or mortgager on that property, they can't go after my car or my bank accounts. They're limited to repossessing any properties I pledged in the contract on the home I bought or tried to buy. That's the only right the lender has if the loan is a non-recourse loan. That's very uncommon outside the US. Around the world, it's much more common to give lenders recourse, to let them go after you, no holds barred. So in the US, no matter how wealthy I am, no matter how many second and third homes I might have, no matter how much I have in the bank or in stocks, if I decide to walk away from my loan, the only recourse the lender has is repossession of the mortgage property. That specific or anything that I put up along with it. We live in a remarkable country, if you live in the US, one with limited financial consequences, remarkable or, remarkably irresponsible. Potatoes, whatever. Lenders in the US have no right to go after any of our other personal assets. That's all you have to remember. Outside the US, God help you, it's mostly recourse loans. If you were to default on a property, you would end up being liable for the full amount of the unpaid debt, even if the lender has repossessed the property already. Point here is that the exposure of the investor in a pool heavily affected by whether the loan is considered recourse or non-recourse. What are we talking about? Oh, different categories of mortgage-backed securities. The important dimensions that let you slice and dice mortgages and risk. So the other categories of mortgages, they can be categorized by property type, the R and C in RMBS and CMBS, residential mortgage-backed securities, RMBS, commercial mortgage-backed securities, CMBS. RMBS where people live, CMBS, where people work or shop. What else? Mortgages can be characterized by the terms of the loan. Was there a large down payment, small down payment, no down payment? Was the borrower a prime borrower? Credit score of 660 to 719? Or a subprime borrower, which is, a credit score between 580 and 619? Man, he's good with numbers. Did you know that there are people who are called super prime borrowers? That's nuts, right? Their credit scores are 720 or above, and they can fly. They're actually superheroes. Okay, other terms of the loan that can be characterized. Are the loans fully amortizing or interest only? Fully amortizing or fully amortized means that you're paying down both the interest and the principal every month, while interest only obviously means you really needed a lower mortgage payment and made an unholy deal with the devil, and you're only paying interest. Other categories. Is it conforming or non-conforming? That's a US specific jargon for which it means it ties back to which agency underwriting guidelines are used. And that's an important distinction because there's a whole industry tied to conforming loans, giant businesses that three of whose I mentioned very early on. Fannie Mae, Freddie Mac, Ginnie Mae, all these giant mortgage players they're confined to securitizing conforming mortgage loans because those loans satisfy, the company's underwriting guidelines. They conform to their underwriting standards. If you want to play with the big players, the big three, well, you have to meet certain terms and conditions. Any loan that doesn't satisfy those underwriting guidelines is non-conforming. That's where you get the word. Underwater mortgages. A mortgage is an underwater mortgage when the loan balance, the amount you still owe, somehow is more than the value of the house. Housing bubbles that burst tend to do that. If your loan balance exceeds the property value, if it's underwater, you better love that house or plan on living in it forever, because if you sell it right there and then, you might not get your equity back. The money that you put as down payment, you might not get that back, or any amount you've chipped off the original principal by paying your mortgages up to that point. An underwater mortgage sounds awful for the homeowner, and it is awful if they need to move, especially, right? And it's awful for the mortgage pool that they're in. Well, that's risk. The risk of the person who is underwater just stepping away from the home and the mortgage, which in a non-recourse world, right? Normally I'd say that an underwater mortgage is rare and it's in, and normally I'd be right if we were just talking about good economic times, but we have lived through enough downturns, and the cycle of upturns to downturns seems to be speeding up. So if there was a massive downturn in like the 1930s, and then 40 years passed before there was another one in the 1970s, well, the next one after that wasn't 40 years later. It was 20 years later in the 90s. And then again in the financial crisis of 2008. I think it's reasonable to think that that lazy sine wave is going to get, more caffeinated, denser, from bubble crash to bubble crash, bubble crash, bubble crash, right? In the last big downturn, like 25% of residential real estate mortgages in the US were underwater. 25%. If you weren't in the top tranches of of our MBS, that AAA platinum level, that first class seat, well, you got what you paid for. So what happens to an underwater mortgage if the homeowner wants to walk away or has to walk away, like a short sale? That's what happens. That's when the property is sold for less than the amount of the outstanding loan. The lender is screwed, right? Another reason why lenders would bundle their loans for sale as our MBS, because then the pool is screwed. The investors in the mortgage-backed security eat the risk. That's actually why the process of securitization bundles thousands of loans together to distribute the risk of just, holding a small number of potentially failing mortgages. A short sale on an underwater mortgage, especially if it's a non-recourse loan, the kind where you can't go after the homeowner's other assets, well, someone's eating that loss. That's just the risk of doing business. If you get to the point where the amount of the outstanding loan, let's call that the debt, where the amount of the debt is greater than the property value and the loan is non-recourse, you have an incentive as the mortgage holder, the homeowner, to just walk away from that loan. The risk is lessened if that's my primary home, because no one wants to move back into mom and dad's basement. So the quality of the loan in that mortgage pool's view improves if the loan is for a primary residence. That makes sense. If the loans in the pool are for second homes or investment properties, the kind you flip during bubble markets, well, that pool carries additional risk. Most adults don't walk away from their primary home. They bunker down and think long-term, because down markets don't last forever. What you're really giving up by committing to be underwater is your optionality for moving. That kind of commitment does not hold for investment properties. Most people just walk away from those kinds of underwater loans, especially if it's a non-recourse loan, because it's completely transactional. Much less emotion involved with investments than, say, with the house that your kids grew up in. So, investor-owned, investment-driven properties where the loans are underwater see a lot of walkaways, and that lowers the quality of the pool even before the walkaway happens. More definitions. What types of mortgages are there? Two broad categories: fixed rate and variable rate. Fixed rate means that the interest you pay, the terms of the loan, remain the same for the life of the loan. 30 years fixed means that your fundamentals, like your interest rate, remain the same for 30 years until it's fully paid off. And variable rate, obviously, means that the interest rate, the fundamentals will change. There's a little bit of magical thinking that goes into taking a variable rate loan. Thoughts like, I'll get a better interest rate in a few years. The bank clearly isn't as smart as I am. What I've told my kids is simple. The bank is smarter. If the only loan you can afford is a variable rate, it's not time to become a homeowner. Wait longer, exercise some patience, save some more, put down, wait until you can put more down. Never eat a hamburger today that you intend to pay for next week. And never, ever, if the price of that burger is market price. Which I'll get into what that references to with these variable rate balloons. Anyway, you're not one of my kids, and who knows, maybe you're smarter than the banks. Moving on. The most common types of mortgages in the US are called fully amortizing loans, which means you make every payment according to the original schedule on your loan. So if you have a 30-year fixed, after 30 years of sticking to the same terms, your loan will be fully paid off. The word amortizing just refers to the amount of principal and interest paid each month over the course of your loan. All you need to know as a borrower on a fully amortizing loan is the amount you're borrowing, your rate, and the term. You also need to know how long, obviously. So let's say you need $1 million. The rate is currently 7-ish%, and your term is 30 years. Well, your fully amortizing loan calculates the amount of your monthly payment, all your monthly payments for the next 30 years, the life of the loan, like 360 monthly payments. All that's calculated before you sign any docs. It's like, clockwork. By your last payment, you will have paid off every cent, principal and interest. No drama. If you enjoy drama, enter balloon loans, which is where I think Stephen King got his inspiration for that horror movie, It, or the book, It. With balloon loans, you actually have two schedules. There's one schedule where you're supposed to pay down the debt regularly, but there's also a balloon date. Ominous. Sometime in the future, usually like 5 years from the first payment, the entire principal comes due on that date. I don't know anyone who actually pays the balloon. They just go to some other lender before that 5-year mark and refinance the loan. Kick the ball down the road. That's the reason I think Stephen King called that balloon carrying clown Pennywise. Balloon loans. Red balloon loans. Pennywise. Pound foolish. Similarly, there's a kind of mortgage called interest only, because that's all you're paying for the first several years, the interest. It used to be tax beneficial back in the day when you got breaks on the amount of interest that you paid, again, back in the day. But I'm not sure why a homeowner would take that option anymore. Don't get me wrong, like on interest only loans, you're not just paying the interest, you're paying the principal too. There's something called a maturity date of the interest only loan on which the full amount borrowed becomes due. The advantage outside of the old tax laws is that the initial payments are, in theory, cheaper, but it's still a red balloon, a clown in a sewer grate. I advise my children, not you because you're an adult, but I advise my children, just get a 30-year fixed. No drama. Okay. So we just talked about fixed rate mortgages, fully amortizing, balloon, and interest only. The other broad category of mortgage types is variable rate or adjustable rate mortgages. This is where you start talking about ARMs. ARM. It's an acronym for adjustable rate or mortgage. ARM. ARMs are loans with an interest rate that adjusts over time based on the markets. That was a little joke about market price. ARMs usually start with a lower interest rate than fixed rate mortgages. So an ARM is, I was going to say great, but it's not really. It's really terrible. It's an option if your goal is to get the lowest possible mortgage rate starting out. The interest rate on an ARM won't last forever. All the variable products, I advise my own children again to stay away from, because after the initial cheap period, your monthly payments will fluctuate. That's my polite way of describing it. Instead of reading the word variable as cheap, you should read it as dangerous, especially if you care about budgeting and you're not independently wealthy. The other class of variable rate mortgages, not ARMs, are called hybrids, because like good hybrid fusion cooking, they're a combination of two things. They're usually one part fixed rate mortgage and one part adjustable rate mortgage. With hybrids, there'll be 3 to 5 years when the rate of interest is fixed, and then the rate is going to reset. And despite what we all tell ourselves there are rarely any pleasant surprises when the reset happens. The main difference between ARMs and hybrids is the length of that quiet fixed period, the calm before the storm. If the initial period is a year or less, it's an ARM. If the initial period is more than a year, then it's a hybrid. Okay, that's enough of a foundation on mortgages to get to securitization and issuance. It's a fancy way of saying, how millions of mortgages are bundled into mortgage-backed securities. If you remember the brief history earlier in the walk, up until the 70s, the vast majority of mortgage loans originated or were held by the originating lenders as, I think I called them boring interest-bearing assets. But starting slowly in the early 70s and speeding up to the late 70s and early 80s, and in fact, running like Usain Bolt by the late 80s, securitization became the default in the industry. By that point, somewhere between 85 to 90% of all conforming mortgages, remember, conforming mortgages are the ones that satisfy the agency standards, about 85 to 90% of them were being securitized, of all of them. In the build-up to the financial crisis from the mid-90s to 2008, home loans were an industry intent on only one thing: securitization. There were giant lending machines just cranking out loans, not because they cared about the dreams of home ownership, but because they needed to keep demonstrating growth to their shareholders. Long after all the qualified buyers were satisfied, well, they started giving loans to anyone with a heartbeat. Subprime loans, you've all heard those. No money down, nothing. These were huge companies, subprime lenders. Countrywide, is on your side, remember that? And Washington Mutual. Those were the two big ones here in the Northern Rock in the UK, one of the smaller ones in the US. AmeriQuest, New Century, American Freedom, any company with like an eagle logo. Hell, E-Trade was doing subprime lending. Why? Certainly not because they wanted to keep those loans on their books. They were doing it purely for securitization. And taxpayers paid for it all in 2008. The lending industry has, for the most part, lost that fever. They're back giving loans to good credit-worthy moms and pops who can satisfy agency standards. The securitization that continues today put those higher quality loans together and sells them to investors. All the payments made on those loans by the borrowers flow through servicers who in turn pass the money into the legal entity, the pool, the trust account, the corporate structure. The legal title to the mortgages themselves are held by the pool, the legal entity that investors buy into. If you're the one making those loan pools, if you're the syndicator, you want them to be as homogeneous as possible. It makes risk management a lot easier. You want them to be the same type of properties, the same kinds of terms on all the loans. For instance, they should all be 30-year fixed loans, and you definitely want them to have the same or similar interest rates. Your clients, the investors in the pool, will always appreciate homogeneity. As I said, it makes it easier for them to calculate risk, to figure out the rate at which the homeowners in the pool will repay or walk away. That's easier, not easy, but easier when you're comparing apples to apples. If you were to create a pool and just randomly throw a bunch of different mortgage types and different borrower types of different term types, well, you'd need a much better, more sophisticated model for risk management. Homogeneity in a pool allows for simpler and therefore more accurate analysis of risk. And that's all investment really is, risk management. The big US players in mortgage securitization, I mentioned them twice on the walk so far, the Freddie Macs of the world, the Ginnie Maes, the Fannie Maes. they focus on pass-through securities. They don't always use those exact words. Like Freddie Mac calls them participation certificates. I'm guessing because they have kids who play sports. I don't know. Let's talk history of those securitizers. The infrastructure for all of this. The secondary market for mortgages in the US. It's laid in the 1930s when the government created what's called Ginnie Mae. That's the Government National Mortgage Association, Ginnie Mae. And it was in 1936 that they did that. Then in 1968, when only the best people were born, the US government reorganized Ginnie Mae and it split it into two pieces, giving birth to Fannie Mae, the Federal National Mortgage Association. The idea was to split by the types of mortgages they were intending to securitize. A couple of years after that, in 1970, the US Congress chartered Freddie Mac, again, not to lend directly to borrowers, but to operate in the US secondary mortgage market, buying loans. So in theory, those lenders could then provide more loans to you and me. It was meant to keep capital flowing into the housing market. Freddie Mac, did I say what it stands for? I didn't. It's the Federal Home Loan Mortgage Corporation. Yes. Like Ginnie Mae, like Fannie Mae, those three became the titans of mortgage syndication, pooling all the mortgages they bought into securities, which they continue to sell to investors around the world. Ginnie Mae issued its first pass-through security in 1970. Freddie Mac issued its first mortgage-backed securities in 1974, and then Fannie Mae issued its first pass-through securities in 1981. The main difference between Ginnie Mae on the one side and Fannie and Freddie on the other side is the type of mortgages that will be in their securitizations. Ginnie Mae, their pools can only include mortgages that were originated under U.S. government mortgage guarantee programs. FHA, which stands for Federal Housing Administration. The Veterans Administration, something called RDA, the Rural Development Association. Government programs meant to help veterans and other underserved communities own homes that help the government expand home ownership. Those same kinds of loans, government-backed or government-guaranteed, can also land in Fannie and Freddie securitizations, but they make up a tiny portion of those pools. Fannie and Freddie focus mostly on conventional mortgages, not government programs. Oh, and today, Fannie and Freddie Mac compete with one another. Why would two government agencies compete with one another? Because they're not actually government agencies. Well, Ginnie Mae is a government agency, but whenever you hear the word agencies in the MBS space, it's really a reference to all three: Ginnie Mae, Fannie Mae, Freddie Mac, even though Fannie and Freddie are what are called GSEs, government-sponsored enterprises. Don't get me wrong, Fannie and Freddie's origin story starts with the U.S. government, but they were privatized early on, sold off to investors with the U.S. government owning just a few shares in each. And this is where it all goes a little funny. Agency securities are all considered incredibly safe because they're backed by guarantees. Ginnie Mae, the only one of the three that's still a government agency, well, their securities are backed by the full faith and credit of the U.S. government. Full faith and credit means that if there's ever a default on a loan in a Ginnie Mae securitization, it won't impact investors at all. You just can't get more solid than that, right? They guarantee timely payment of both interest and principal, as steady as government bonds. If they ever go under, we got bigger problems than, late payments. Means the U.S. government went down. So, from the investor's perspective, Ginnie Mae is solid, or as solid as the U.S. government. Fannie Mae and Freddie Mac, well, technically, once they privatized, they only offer what are called self-guarantees. Market participants know that, but they also know that if the government lets them go down, we'll have bigger problems, system-wide problems. That's the kind of moral hazard that kept popping up in the 2008 financial crisis. Market participants know that Fannie and Freddie do not officially have the full faith and credit of the government, but they behave, meaning the investors behave like Fannie and Freddie do, right? Because investors believe that there's some sort of an implicit U.S. government guarantee. It's not explicit, it's implicit. And that proved itself out in 2008 when investors were fearful of holding Fannie and Freddie debt. Well, Uncle Sam stepped in for good reason to avoid the implosion of the U.S. financial system and hence the global financial system. But still, they proved that investors were right to treat non-guarantee as a guarantee. After the crisis, the U.S. put what's called government conservatorship over the once governmental, now privatized Fannie and Freddie. And all kinds of gamesmanship started again. Right now, the U.S. government explicitly says they will provide all the cash needed for Fannie and Freddie to continue to carry on mortgage securitization. Why? Because the government wants to expand home ownership to a wider range of previously underserved populations in the United States. I'm just talking politics. Conservatorship means that while there are still shares outstanding, meaning that they're still private companies, their shareholders, Fannie and Freddie, no longer elect the board of directors. It's kind of weird, actually. Instead of a corporate board holding their C-levels accountable, the U.S. Treasury does, or more accurately, board members appointed by the Treasury do. Their mandate is to minimize losses to those entities and, in so doing, minimize claims on U.S. taxpayers. It's a fine line in the U.S., right? Treasury officials get in front of Congress and they do this little dance. They say, yes, we stand ready to provide all the cash that Fannie and Freddie need to continue to support their mission to expand home ownership. But that does not mean the U.S. government is guaranteeing Fannie and Freddie Mac. Bullshit, you know. The government does not guarantee Fannie Mae and Freddie Mac. But the power of the government rests on the power of the economy. So they create perverse incentives for investors to hold Fannie and Freddie debt. That's what mortgage-backed securities are. They're debt. Remember we talked about debt-based securities like bonds, backed by the interest paid on loans? We talked about conforming versus non-conforming mortgages earlier and about agency underwriting guidelines. I don't think I defined underwriting, by the way, because it means a lot of different things. In this context, underwriting guidelines are the terms or conditions of a person selling mortgages into a pool, terms or conditions that they need to have satisfied before their mortgages are accepted into agency securitization, into those pools, the Freddie and Fannie pools. In other words, if you want to work with Fannie or Freddie, you have to know their rules, follow their rules. Once every mortgage you're selling meets all the terms and conditions required by them, they're called conforming loans and can be packaged inside the pool, inside the agency securitization. Back to the history lesson. Remember subprime mortgages? Those toxic pools that almost brought down the global economy in 2008. Fannie and Freddie did not hold subprime mortgages, subprime securities. Their investment portfolios wouldn't allow it because their rules didn't allow them to securitize garbage. Their rules wouldn't let them securitize subprime mortgages because they could only securitize conforming mortgages. There are many loans out there that are not conforming mortgages. Some garbage, some not. Some of their terms and conditions fall outside agency underwriting guidelines, some don't. And nothing prevents private sponsors or originators, not Freddie, not Fannie, from creating mortgage-backed securities on garbage, pools of yuck. The funny thing is that Fannie and Freddie still had to be rescued despite their standards because of the fragility of the system. If one institution falls out of the boat and starts to sink, well, they're usually handcuffed to a couple other institutions who are each also handcuffed to a couple of other institutions, and so on and so on. And so, without government intervention, everyone's at the bottom of the river. And where the banks go, so too go your deposits. Whether you have a mortgage or not, whether you know what the acronym MBS stands for or not. Okay, enough history lesson. No one ever learned anything from history anyway. So, now that you know about the agencies, let's get into some details about what it means to strictly follow those standards. Remember, that's how you get a conforming mortgage, one that you could have them securitized versus a non-conforming mortgage that doesn't follow their standards, and you can't have them securitized. When it comes to conforming loans, size matters. Politics matters. There's a max size for the loans, how big it can get, a loan, tied to an index of residential real estate values. The politics of it being that, you want to help the little guy or gal, the middle class folks. Every politician can get behind helping mom and pop buy their first house. And no one in the government wants the optics of, we're helping rich people buy really big houses with fences to keep away the unwashed, right? So there's a maximum size to a conforming loan. It changes because housing prices keep going up and up, decades after decade. Right before the financial crisis in 2008, that max was $417,000, which if you were living in like San Francisco, meant you could buy a really nice parking spot. And to be fair, the government tried to fix that by raising the limits, adjusting for the higher cost of living in cities. I could keep throwing numbers at you, but those numbers change over time. You can Google maximum size of conforming loan, and you'll see it. It's a little over 1 million now. There's a size limit if you need a loan to be eligible for inclusion in an agency pool, and it's driven by politics. There will always be larger loans available and non-agency syndicators who will be interested in creating, rich people pools, second home pools. And that's where we get jumbo mortgages. They're too big for the agencies. Given the politics of home ownership, you're always going to have a line above which it's just not politically sound to provide. Anyway, non-agency syndicators would be interested in like a Hamptons pool because in theory, the credit quality of richer borrowers is better than poorer borrowers. Lenders don't just say, hey, you're rich, here's some free money. Government does that, but not lenders. If you need a jumbo loan, the bank will make sure you're creditworthy, reducing their credit risk. Jumbo mortgages were one of the first primary sources of securitization for non-agency syndicators for exactly that reason. Long before they started messing with subprime garbage, they were dealing in rich people-backed, high credit quality products, right? From a credit risk perspective. The paradox here is that if your borrowers have high credit quality, they also have easy access to credit, which is a fancy way of saying rich people aren't as reliable as middle class mom and pop. To use industry jargon, rich people don't have the most attractive prepayment characteristics. The spoiled are spoiled by easy access to money, I guess. Okay, so 1, size matters. What else makes a loan eligible for inclusion in agency securitization? Two, the borrower has to be top rated. That's where you get terms like AA borrower. That's the highest credit rating for someone in the US. We're talking individual credit rating standards now. And that depends on your credit history. Do you have a history of making all your payments on time? Car payments, credit cards, iCloud storage? Have you declared bankruptcy in the last 7 years? If you have a decent credit score, you qualify as a prime borrower. If you don't, if your credit quality is less than Beyonce's, you're considered a subprime borrower. And only loans tied to prime borrowers get into agency securitizations. What else? Size matters. The borrowers matter. Next, some jargon. Loan to value, LTV. It's a ratio, something to something. In this case, loan to value. It's the ratio of the mortgage loan amount as a percentage of the total appraised value of the property. That wasn't helpful. An example. Let's say I'm buying $1 million property and you're my lender. Would you rather that I borrow $200,000 from you because I have the other $800 I'm going to sink into the property? Or would you rather I borrow $999,000 from you because I have, $1 I'm going to invest? You're the lender. It's not a question of whether you have the money or to lend. You do. It's a question of what lets you sleep better at night, because it's, as a slider from $1 at one end and the full million at the other, where on that slide lets you sleep better at night as a lender, right? That slider, loan to value. As a lender, if you want that loan to land in a pool, the agency standards are 80% max loan to value. The amount of the debt I would be taking in that example can't be more than 80% of the cost of the property at the time of the loan. That means in $1 million loan, you can't take more than $800,000. If that still wasn't helpful, well, LTV, loan to value, is why every bank would love for you to put down 20%. You've always heard do 20% down. Part of why you pay less after 20%, after you own 20% of your property, you stop paying what's called mortgage insurance in the US, which is insurance that the lender forces you to pay in case you default. The probability of default reduces after that 20% marker. Can a borrower put down less than 20%, like 10%? Sure, if they have good credit and if they pay mortgage insurance. But that mortgage that they take out won't land in an agency pool. You follow? What else? Size, borrower, loan to value, and the final one. Prove to me, the lender, how much you make, your income, and prove it in a way that's acceptable, that meets agency guidelines. In the US, for instance, that's like a W-2, which is a tax form that says how much your employer paid you. If you're self-employed, you're called a no-doc loan, no documentation of the income. But as long as your credit quality is acceptable, you still qualify for the loan. But that loan will not land in an agency pool. Your mysterious source of income disqualifies you. Your loan is then classified as an Alt-A loan. Back in the day, that used to mean you were a good credit risk. But during the lead up to 2008, standards outside the agencies just fell so low that Alt-A's were also called liar loans. No one in the industry thought the borrowers were lying. It was the disreputable lenders that were lying, throwing credit risk to the wind. Using what we've learned, we get to the point where we have a pool of loans that are relatively similar maturity, all high credit quality. They meet agency guidelines. They all have interest rates relatively close to one another. Yay, securitization can proceed. Let's walk through it step by step. The people who have mortgages in the pool keep paying their monthly bill to what they think is their bank, which many times isn't the actual bank, but a servicer, think ops for incoming checks, pass the principal and interest less a servicing fee on to the legal entity that owns the mortgages, and the money then gets distributed to investors in the pool. That servicing fee is payment for handling the money, running the operation, sending out payment notices, sending out late notices. In other words, not all of the principal and interest that's flowing into a pool is going to be paid out to the investors. There are service fees kept by the servicers for doing their job, and there's something called the excess spread, EXCESS, excess spread. That's kept by the sponsor, the entity that created the mortgage pool. The servicers and sponsors have bills to pay too, various administration fees, expenses that they have. And once those fees and expenses, the excess spread, are taken out of the interest, and they're only ever taken out of the interest, the whole principal and the remaining interest move forward in the process, getting paid out to the investors. That's also called the prorated distribution of funds. How does it pay out? The math is relatively straightforward. Let's say there are only 2 investors in the pool that has $1 million of mortgages in it. One investor has bought 10% of the pool, the other 90%. Because this is a pass-through mortgage-backed security, that's how much they get of the money that passes through. Investor 1, who has bought 10%, gets 10% of the principal that's passing through. And investor 2, who has bought 90% of the pool, gets 90% of the principal that's passing through. Same distribution percentages, 10, 90, on the interest that's passing through. But again, remember that it's less the servicer fee and the excess spread. When does it pay out? The beginning of every month. If one of those borrowers was late that month with their payment, and this is, an agency pool, well, the agency sends the full amount due to the pool because they guarantee that delinquencies wouldn't happen. One subtlety worth pointing out, and it has to do with the coupon rate, which I haven't talked about on the walk so far. A coupon rate is the annual income that an investor can expect to receive while holding a particular security or bond. The investors might or might not know the interest rate that their pool of borrowers are paying, each individually in the pool, but the investor will definitely know the coupon rate of the pool because that's what they themselves expect to get, right? That's what they paid for. The sponsors and syndicators of the pool know that, so they price the pool appropriately. They know how much the servicers are going to demand and how much they need to pay monthly expenses, so the coupon rate manages the investor's expectations down to the penny. The money that doesn't pass all the way through to the investor is the money paid in fees and expenses, what's left after the middlemen are paid. And this payment distribution model is pass-through specific. It doesn't work like this for CMOs, collateralized mortgage obligations. Remember, CMOs have more expensive tranches, AAA, platinum, first-class seats. That usually gets all the principal, the first-class seats do. Then they share the interest with the lower tranches, the coach, economy seats. The investors who paid less get less. That's intentional design. CMOs structure payouts so that, unlike pass-throughs, all investors are not going to get an equal split of the pro rata share of every dollar that comes through the structure. Instead, they'll get paid out for their quality of seat on that metaphorical plane. And first class is more expensive, so it might have a different rate of interest returned than, business class, which itself has a better seat and terms than, say, economy class. And that's interest. CMOs design their payouts to do the same thing with principal. And the most egregious part of that structure, the design of the plane, is that they only have exit doors in first class. So if you're sitting in first class, what's called the first tranche, and you were promised $1 million of principal, well, no one in business class in the second tranche gets a penny of principal until you've gotten your million. The term of art for that is tranche retirement. No one in business class in the second tranche gets a penny of principal until the first tranche is retired. And the same rule applies to the second tranche and the third tranche. Between the third tranche and the fourth tranche, it's, no one in tranche 3 gets paid until tranche 2 has retired, all the way down to the last seats on the plane, that last tranche. And that's the simplest of all CMO structures. It's known as sequential pay bonds, or just sequentials. Think airplane seating. If you have the money, you can buy certainty, you buy less risk, you can manage the uncertainty of the average life, you can manage prepayment risk better. CMOs, the planes, in my crappy analogy, can and are designed to be a lot more complex than sequentials. You can Google Z bonds, the letter Z dash bond tranches, or floating rate tranches, or you can Google something called inverse floaters. PAC bonds, that's PAC, planned amortization class bonds. Google them to get a sense of the more common types of complexity or products that are built. Just know that it's not complexity for complexity's sake. It's because plane designers, CMO syndicators, understand the complexities of risk management. They understand their clients' businesses, their clients' risk management needs, and they build more and more complex planes, CMOs, collateralized mortgage obligations, to address those client needs. Everything in finance is about risk management. The lingo investors use when they're evaluating mortgage pools: 3 big ones: the WAC, the Wham, and the Walla. WAC is short for weighted average coupon. Wham is weighted average maturity, and Walla is weighted average loan age. Let's define them. WAC, weighted average coupon, is a measurement of the rate of return on a pool of mortgages that's sold to investors. The underlying mortgages are repaid at different lengths of time. So WAC represents its return at the time it was issued and may differ from its WAC later. Don't worry, I'll simplify in a second, right? So Wham, the weighted average maturity, is a measure of how quickly principal will be repaid according to the bond's debt service structure to its terms, right? Walla, the weighted average loan age, is a measure of the maturity of the mortgages in the pool. Walla is dollar weighted based on mortgage size and the time left until it matures, usually in months. Okay, that was densely packed. Let's break it down. They're all weighted averages. Let's start there. Calculations that take into account the varying degrees of importance of the numbers in a data set. When you're calculating a weighted average, each number in a data set is multiplied by a predetermined weight before the final calculation is made. If you're not a math whiz, I'm still talking Klingon. So let's simplify. The weighting is what percent of the principal on any one loan is as a percent of all the principal currently outstanding. It changes over time as some of the homes in the pool are sold and the mortgages of the homes in the pool are paid off, or some of the loans in the pool are refinanced. Point here is that weighted averages allow you to get your arms around data sets, right? Numbers that keep changing. Each month, these weighted averages are recalculated. That's both expected and useful. So you know what you have on a month-by-month basis as a bundle. it spells out the forest, so you don't have to know all the details of every single tree, every mortgage in that forest. So how do you calculate the WAC? You take the coupon rate of each mortgage in the pool and you multiply it by its remaining principal balance. The results are added together and the sum total is divided by the remaining balance. You don't need to memorize that. You need the formula in Excel, and you can Google that by just looking for weighted average coupon calculation. Just look it up, you'll find it. Life is the kind of test where you can use notes. So how do you calculate the Wham? Let's move on. We'll use an example here. I'll try to put it up like right here once I get back to the house. So if you need to see it as I'm talking through the calculation, I think that would make it easier. I'm going to split this $1 million pool that's hopefully up here now into 3 weird chunks deliberately so that you can better match the numbers once I get to the calculation. So let's say our investor has $1 million pool and she has all of it, everything she wants. $1 million is easy to remember. And let's say that the pool is down to 3 mortgages as of last Christmas. And these 3 mortgages are some bad boys. Mortgage A is for $167,000 or 16.7% of the total portfolio. And let's say it matures in 10 years. Hopefully that's written up there, right? Mortgage B is for $333,000. And there's a lot of kids walking by. That's super cute. I don't know if you can see them in the distance, but they must be on a field trip today. Anyway, $333,000. And let's say that one matures in 6 years. So that's 33.3% of, of the pool. And again, it matures in 6 years. Mortgage C is for $500,000. That's easy. It's 50% with a maturity of about 4 years. Now to compute Wham, each of those percentages is multiplied by the years until maturity, which I also gave. So in this example, the formula would be 16.7 times, that's the percent of the first one, times its years, 10 years, plus 33% times 6 years, plus 50% times 4 years. And all that equals 5 point something, 6-7 maybe, 5.67 years, or about, 5 years, 8 months. Wham, right? If you're a math whiz, that calc is the edge of heaven. But if you struggle with your math, then I'm your man, because math puts people like you and me to sleep, which is okay. Just, wake me up before you go. Wham. Rest in peace, George. All right. Next, let's calculate Walla, the weighted average loan age. You multiply the value of each individual mortgage in a pool by the number of months since the mortgage loan was originated, since it's first started, right? When it was birthed. Walla is used to estimate both profit potential and prepayment risk. Profit potential is precisely what it sounds like. How much money am I going to make? Prepayment risk in this context is how likely is it that mom and pop homeowners are going to prepay their principal to get out of their loan faster. And while that might benefit mom and pop, to the investor, that bye-bye future interest payments, right? That's risk. Okay, that was WAC, Walla, and Wham, or WAC, Wham, and Walla. Now we just need to define wop, bop, a doop-bop, do-wop, bam, boom. Okay, let's talk WAC and Wham subtleties. WAC, again, the weighted average coupon. If I say it enough, you'll remember it. The relationship between WAC and the pass-through rate, also called the coupon rate, the rate that the investor was sold as their return, well, that pass-through rate is going to be lower than the WAC. In fact, the agency guidelines say that the lowest interest rate on a loan in a pool has to be at least 25 basis points or 0.25% above whatever the pass-through rate is. At least that much, right? That much more. If our pass-through rate was, say, 7%, then the WAC would be more like, 7 point something, something percent. At least 1 basis point, probably a lot more than that. It makes sense that the weighted average coupon will be higher than the coupon rate. And just know that WAC will decline over time, right? Because the highest interest rate mortgages are the ones that are most likely to be paid off first. And as they're paid off early, the weighted average is recalculated and WAC declines. Wham! So, weighted average maturity subtleties. The only subtlety in the calculation is that the weighted average maturity at origination when it first started is less than you think. If you were new to the business, you might think that the magic number is 360. Remember, 30-year loans times 12 for the number of months. That, comes out to 360, right? So you would think that that's the magic number, but the number is usually less than the total of the loan's life. The reason is because loans don't get immediately securitized. That magic number is probably closer to like 350, 355, because a few of the loans being securitized will inevitably be held by the lender for a few months or maybe a few years before they get securitized. And when you're talking averages, the once in a while cases pull the topmost number towards them, right? So example would be the average number of arms per person, these things in the world is less than 2, if you think about it. Okay. The only subtlety about Walla is that it's useful because to an investor, it matters less when the final payment is due and more how old the loan is. Walla, right, infers how long the loans have existed. The la in Walla is loan age. That's more insightful when you care about prepayment rates and managing risks. Okay, let's get into some formulas. And this part's going to be torture for you, so apologies in advance. The monthly mortgage calculation, which I'll put up here, hopefully. Do you need to know it by heart? Not really. Just Google, how do I figure out my monthly mortgage calculation? But it'll be a calculation that it's worth memorizing. Like it's M equals P bracket I 1 plus I to the N, and that's all divided by 1 plus I to the N minus 1, where you don't need to memorize it. Just look over here at the thing and I'll walk you through it. The M is, hopefully my finger is somewhere close to it. The M is the monthly, your total monthly payment, right? The P is the total amount of the mortgage balance, essentially. And the I is your interest rate as a monthly percentage. N is equal to the total amount of months in your timeline for paying off your mortgage. So you've stared at the mortgage calculation long enough. You know how to Google it. Just download the formula into Excel or Google Sheets and play with it. No better way to learn something like this. So all those formulas and calculations are at the tree level, not the forest level. They're at the individual mortgage level, not the mortgage pool level. If you remember from earlier in the walk, mortgage pools try their best to put together loans that have the same or similar terms, right? They're all fixed, 30-year fixed, or they all have the same or similar interest rates. There isn't any one of these things is not like the other. They're all like each other because risk is easier to manage that way. So if you were to look at a graph of any one dimension for any one individual loan in a pool, for instance, it's scheduled payments, it would look eerily similar to a graph of scheduled payments for the entire pool. But that's deceptive as it relates to the prepayment rate. Let me remind you again what the prepayment rate is. In plain English, it's all mortgage owners in a pool that are paying off their principal earlier than expected. All the people that are hitting the exit, right? That prepayment rate signals how many people are hitting the exit early. If you look at the forest level view of let's say, scheduled payments, it actually looks exactly like the tree view, right? Multiplied. So it's like a giant, whatever. It could lead you to think there's a zero prepayment rate at the pool level, but there's zero chance of that because, life gets in the way. So the aggregate prepayment rate of mortgages in a pool should remind you of that 7-year itch metaphor I used earlier. This idea that your marriage can last until year 8. If it can last until year 8, it'll last forever. Well, a large chunk of the mortgages in a pool prepay between 5 and 7 years. Why? Because, again, life gets in the way, right? Families grow, they shrink. Mom gets a job across the country. Dad goes out for cigarettes and never comes back. The point is that people with mortgages prepay a lot between years 5 and 7. Not because they suddenly won the lottery, but because mortgages, at least in the US, come with this thing called a due on sale clause, which basically says that if you sell your house, the first thing you're obligated legally to do with that money is to pay off the loan, to become someone who, from the pool's perspective, is prepaying on what is now their old mortgage, right? So even if the interest rate environment, right, gives you zero financial incentive to refinance your loan, a mortgage pool will still have a fair share of prepayments by the homeowners in the pool, or at least for those homeowners where life just, got in the way. So the graph for prepayment for the pool doesn't look like the one for scheduled payments. Scheduled payments is like a gentle hill sloping down slowly over the course. So it goes like this and then, right? The prepayment slope rises up to year 7, right? And then precipitously drops and evens out over the next 20 years. Either way, the pool gets all the principal from all its mortgages, all the mortgages that prepay, right? They just reduce the pool's long-term profitability because each prepayment takes some or all of its future interest payments, the profit, off the table. That's why no one gets excited by, years 15 through 30 in a pass-through pool. Most of the interests are paid in years 1 through 15, and the loans are just sitting, on the porch in a rocking chair, watching the sunset. Cash flows were something it had when, it was young. Okay. So let's get into the details of mortgage prepayments. If you're working with the agencies, credit risk is not an issue because they guarantee full payment every month, even if some of the mortgagors are late in their payments or worse. What do investors focus on then when credit risk ain't a concern? Prepayment uncertainty. A less than spectacular average life of a pool that could result from a high or lower than anticipated rate of prepayment. I briefly touched on the factors that drive prepayments, like 200 yards back, but let's go deep. The most obvious fuel for mortgage prepayment is interest rates. At what rate can a person who already has a mortgage take out a better mortgage with better terms today, right? And ideally, can they do it without paying some unreasonable lump sum, like exorbitant closing costs? An example of what I mean by that. Let's say I personally take out a loan at the rate currently 7%. And, magic happens in the macroeconomic view, and tomorrow's interest rate is 6%. If I refinance immediately, because I just, bought the house, just took out the mortgage, that could give me thousands or even potentially tens of thousands in savings in any given year, depending on the purchase price of my property and the total amount of the mortgage being refinanced, right? That might be a no-brainer if it weren't, for closing costs, the fees you pay for the processing of buying or selling. Average closing costs for a buyer run somewhere between like 2 and 6% of the loan amount. That means if I had a $300,000 house or a $300,000 loan, I would pay something between $6,000 and $8,000. No, $6,000 and $18,000. I did that math wrong in closing costs. In addition to, to the actual down payment that I would need to produce once again for the house. Do I have $18K today? Well, maybe. Is it worth the hassle? Maybe. Only the homeowner really can answer that question. The point is that interest rates drive a lot of homeowners to at least ask those questions for themselves. It's an expensive question not to ask. Usually, when mortgage rates go up, the opposite direction that, the example I just gave, prepayment rates tend to go down. Makes sense, right? Why would a person with a 30-year fixed at 7% refinance when the interest rate goes up to 8%? They wouldn't. And when that happens, usually housing sales slow down. Another economic indicator that prepayment rates in pools will go down, right? Flip that, and the opposite is also true. Falling interest rates mean more people are refinancing, which, because of the due on sale clause that we talked about, the pool will experience the refinance as a prepayment, right? And falling interest rates tend to drive housing activity up, which means prepayment rates in pools also go up. So the whole process is interest rate sensitive. What else do investors focus on? If not credit risk, if not interest rates, the economy, demographics, politics. Is the population growing, shrinking, moving from where to where, and at what scale? How old is the population? Because younger folks equals higher demand for housing. How is the job market doing, right? Are people losing jobs, getting jobs, switching jobs? Because buying a home usually means you need to be making money, right? Good money. Ideas like a consumer's purchasing power, their access to disposable income, whether they're tapping into intergenerational wealth. All of these factors play into prepayment models, which just try to figure out people's willingness and ability to buy a house or refinance their existing house, all in the hopes of trying to predict prepayment rates. Hell, even the weather needs to be modeled in, right? Seasonal considerations. Whether it's sunny or cloudy or raining or snowing, but impact prepayment rates, right? For instance, prepayment rates are great in the winter because who the hell wants to move when it's cold? Remember, Whack and Walla? Well, the weighted average coupon, I'll say it one more time, the weighted average loan age, Whack and Walla are important for exactly what we're talking about, right? They were designed to assess prepayment rates, prepayment risk. The Whack gives investors some insight into prepayment across pools. What's the likelihood that pool A will prepay relative to pool B? Because investors have lots of pools to pick from, right? Imagine that two pools, A and B, have the same pass-through rate, 6%. How would you differentiate? You would just go, I don't care, give me either one. No, you wouldn't. You would look at their WAC, right? If pool A has a WAC that's higher than pool B, buy pool A. There's less risk, more potential cash flow over time. The higher WAC, as long as the modeling underneath it is sound, has a greater likelihood that its prepayment rate will pick up sooner. Pool A's higher WAC means it has higher interest rate mortgages in that pool. And that correlates with pool A having its prepayment rates rise sooner. Pool B would catch up at some point, but pool A's sooner is better. You're supposed to make money from the cash flows. One, by reinvesting the income that you're getting monthly, and or two, you make money by changes in the product's price. But unlike other fixed income products, pass-through mortgage-backed securities give you a ton of cash flow, a lot of cash flow, which means you have more reinvestment risk. That's another fancy way of saying you'll get so much cash flow that it might actually be hard to invest at all. Reinvestment risk, right? Plus, the pricing on pass-through is different. More like callable bonds. It's something called negative convexity. Wow. Two words only used to make you sound smart. It just means that they get cheaper as interest rates go down. And that's unusual because when interest rates fall, bond prices typically rise, right? Unlike bonds that can tell you exactly how much you'll get in month 1, month 2, month 20, month 24, every month, mortgage-backed securities come with uncertainty for exactly the reasons we've been talking about today. Homeowners in a pool can make prepayments, which means month one's cash flow might be a little less than you expected. Uncertainty is not a showstopper because investors know what they're getting into and they use projections based on some assumed prepayment rate. For instance, there's something called short for Public Securities Association standard prepayment models. It's a prepayment benchmark, not a model, but a benchmark based on another benchmark called CPR, the conditional prepayment rate, CPR. They're a measure of relative prepayment speeds. For instance, 100% PSA equals a starting rate of 0.2% each month for 30 months, at which point prepayments level off, stay constant at about 6% CPR for the remainder of the life of the mortgage. I'll do the math in a second. How do you talk about PSA, about the prepayment benchmark? Well, thank God we've been talking what we've been talking about, because PSAs, the PSA speeds always rise steadily over the first 30 months, after which they level off. So the prepayment rate rises up to the 30-month mark and then flattens at a constant level for the next 330 months. Investors talk about PSA speeds in terms of percentages, like 50% of PSA, 150% of PSA, where the standard is 100%. That 100% mark is actually called the PSA standard. The other way investors talk about the PSA is through the analogies of aging mortgages or the seasoning of mortgages. That's a term of art, because seasoning. Because new mortgages, baby mortgages, like early on, their prepayment rate will be close to, because why put yourself through the hassle of lawyers and closing costs just to immediately sell or refinance? as mortgages age up to that 30-month mark, their prepayment rates are going to rise, unpredictably, but predictably unpredictable, which sounds like a book Dan Ariely might write. If you're a math person and need a formula for the ramp speeds, the monthly increase in CPR is terminal CPR, the conditional prepayment rate, divided by the length of the ramp. Remember how I said that the 100% mark is actually called the PSA standard? I did it like 100 yards back. Well, if you take the formula of terminal CPR divided by the length of the ramp for the standard PSA, that would be 6%, the CPR, divided by 30 months, the length of the standard ramp, and 6% divided by 30, drum roll please, 0.2%. If you do the math, that's just me showing you that I know how to do basic arithmetic for what I talked about, a little while back. That 0.2% is also called the step up. That's a term of art. So we're using PSA standard. If we're using it, you can just take the month that you're in, like you're in the 6th month, and multiply it by the step up, 0.2%, and you'd get the CPR, the conditional prepayment rate, of 1.2%. At 12 months, the CPR would be 2.4%, and so on and so on. Next, there's something called SMM, single monthly mortality, which is measured as a per month percentage of mortgages in a pool that will be paid off early. When investors want to estimate monthly prepayments, they take the CPR and convert it into a monthly prepayment rate, the SMM. The formula for SMM, I'll put it up. It's 1 minus CPR to the 1 to the 12th. And finally, and don't try to memorize that, like Google it, right? SMM CPR formula, and you'll get it all on, in little great Excel formulas. Okay, finally, if you multiply the SMM and the outstanding principal, you get what's called prepaid principal, which is any portion of the principal amount of any pool being paid for any reason prior to its regularly scheduled maturity date. It's a lot of TLAs, 3-letter acronyms, and each one sets the foundation for the next TLA, the next 3-letter acronym. So follow me. The PSA allows you to calculate the CPR, which allows you to calculate the SMM, which allows you to calculate prepaid principal. So PSE, CPR, SMM are how you understand cash flows using some prepayment rate, the benchmarks, and methodology for how you express the potential amount of principal that will be prepaid. If you're in tech and in the MBS space, this is the level of business depth you need, because your business partners are going to keep trying to use code to improve their models for predicting prepayments. Because the better your projections of prepayment rates, the more money you make, the more risk you mitigate. And that's why you are so valuable as a technologist to a business person in this space, because you make all that happen like this. Okay, that's it. I hope you learned something. This clearly is more than an hour, and I'm pretty sure I'm lost. So it'll be a while before I get back. Thank you.